morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Aman Dabash, Nikunj Dalmia in the studios. And, the biggest trigger for the market today is going to be the Fed Reserve meeting outcome. As expected, they've held benchmark rates yet again amid a growing U.S. economy and a labor market and inflation picture that still defies the central bank's targets. In fact, the FOMC has unanimously agreed to hold the key federal fund rates in the range of 5.25% to 5.5% band. Remember, this is the second consecutive meeting that the FOMC has held rates following 11 rate hikes, 4 of which were this year itself. In fact, let's hear out an excerpt from Jerome Powell's speech.
Good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do. We know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether our star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable. And so really, again, what we're focused on is, looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves.
Well, a pause for longer, that seems to be the clear messaging, while they've played on expected lines, keeping a close eye on which way, the trends when it comes to the labor market, the GDP, as well as, where the yields are going to be headed in from here. So pretty much status quo, Nikunj, and you're seeing a big relief rally actually across the board. You're seeing about a 0.6% to about a 1% kind of handover from US markets, and Asia, fortunately, is gathering the same momentum.
See, Aisha, what has Fed said is very simple, that we are not going to increase rates, but we are not ruling out a rate action if required. But our assessment of the US economy is far better than what it was, let's say, a quarter ago at the beginning of the year. Now, the good bit is that Fed has not increased rates. The bad news is that Fed is not shutting the doors on a rate hike in the near term. That door is still open. But what is making markets excited? Well, what is making market excited is the fact that even though the US GDP data, which was red hot, which came in the last sprint, that has not moved the Fed. That is not really making the Fed feel very anxious. And from a market standpoint, since global markets have been, it's been a bad, seasonality which has been at play at least for US markets, and you've not had any good numbers there. Maybe this Fed event is turning out to be a factor which is just helping the market establish a relief rally. So it was not an event risk. I think the Fed commentary is on expected lines. Their outlook for US economy is welcome, and that in a sense is just, perhaps forcing some degree of action and excitement in the global market. So it's like a good feeling to walk into trade this morning that, okay, global cues are strong and supportive, and SGS is indicating a start, or GIFT Nifty, I beg your pardon, is indicating a start above 19,000.
Yeah, because it seems like they're bracing for a long pause. I mean, that's the logical deduction from their commentary.
They've said we are not increasing rates, but we are open to something in the December meeting. The naysayers were of the view that because the US GDP data was red hot, maybe Fed will get anxious, because if the US GDP is strong and if yields are at 5%, they could have been tempted to say something about where and how the rate action would move. But they've not really dropped a hint. All they've said is that, okay, we are not going to be making a case for no rate hike or a rate cut, but we are open to something if the data does not improve.
All right, Ed Yardeni is President and Chief Investment Strategist at Yardeni Research. He's joining in. We've also got with us Steve England, Standard Chartered Bank Global Head Forex Research. Thank you so much, gentlemen, for taking time out. Let's get in your take then. First up, Ed, the Fed holding rates steady this time around. And clearly, when it comes to the assessment for economic growth, there has been a bit of an upgrade. Your takeaways?
Yeah, I think that the third quarter strength is not something that's going to be sustainable. I don't think we're going to see something close to 5% in the fourth quarter. I think things are going to simmer down, but it could be 2.5 to 3%, particularly if productivity makes a comeback. And here in the U.S., when we wake up in the morning, we will get a productivity for the third quarter, and I think that could be surprisingly strong. But the Fed has the perception that at this level of interest rates, it's restrictive enough to bring inflation down, which has been coming down without causing a recession. So they're really trying to get to that Goldilocks scenario, and so far, so good.
So far, so good. But are you surprised that there was no mention of US GDP growth or the US GDP data? The fact that US economy is doing much better than what everybody anticipated a quarter ago, and significantly better than what everybody anticipated at the beginning of the year.
Well, Powell actually didn't get specifically focused on GDP, but he did mention a couple of times that they're very satisfied that with the economy doing better than expected, indeed he said doing better than anyone expected, that nevertheless inflation has been continuing to moderate. So I think they're actually very happy with this combination of strong growth with low unemployment, with inflation coming down. They're having a lot of discussions at the Fed about whether growth necessarily has to be inflationary. So they're like all the rest of us. They're data dependent. They're watching how things unfold. And so far, they're going pretty well.
Steve, if I could get you in here, while it seems that, they're bracing for a long pause, the FOMC, but Jerome Powell also said that he's attentive to the spike in yields. What happens to yields? Because, that's what kind of dictates the global equity market sentiment.
Well, I think that's very important. And, let me say I agree with most of what Ed was saying. The thing about the market reaction to the Fed is that it wasn't just to the Fed statement and Powell. In the morning, we had the Treasury issued its quarterly refunding statement, which was viewed as bond market positive. Then we had, pretty weak ISM manufacturing, which, again, would take some pressure off interest rates. I think a lot of people in the market would be reluctant to buy bonds or buy any asset right before the FOMC meeting for fear of being run over. And then when you had Powell coming out and kind of saying, look, there is sort of this supply side, both in the labor market, maybe in productivity, maybe we'll be able to, the inflation picture looks pretty good. This is the first time I've heard him talk in such a friendly way about wage moderation, kind of saying it's come down a lot. It's, take out productivity. It's not that much above their target. I think the market partly, saw the freedom to do what they would have wanted to do on a normal day, but hesitated to do. And that's why we had such an outsized reaction to it in the course of the meeting and in the, aftermath.
All right, gentlemen, thank you so much for taking time out and joining in with that take. Let's get a move on then and focus in on D Street, because yesterday it was a day of consolidation, to say the least. The fact that 19K wasn't even held on to by the time we wrapped up, it seemed like a sell on rise market, fairly range-bound trading session. Even when it came to the 5-day range on the Nifty index and the Nifty Bank, it seems like it's confined to a fairly tight range. And Nikunj, even when it comes to the FII positioning, longs have been higher for the 5th straight session, but shorts still 5.7 times higher.
See, the market may look like a very volatile market, but it's a very easy market to call. And I'll tell you why it's a very easy market to call, because the market is not going anywhere. The upside is restricted and the downside is very, very well defined. And that's a very comfortable place to be in, because you know that in the near term, the market is not going to surprise you. And if the market is not going to surprise you, then you know that it's a good time to start buying into stocks and perhaps start shopping on where you know that you always wanted to buy. So while markets will adjust, it'll spend some time. The triggers on the upside are not there. The momentum on the downside, because of liquidity, domestic liquidity, always is getting challenged. So this is an easy market to call. What will take the market higher? You definitely need something new. That's not going to come from earnings season. that may not come from any local factors. It has to be something on the global front where something changes or the flow they reverse. So I don't think right now this market right now has any triggers which in a sense could really act as a spring in the stride for the bull. So the upside is defined. Downside is limited. Why? Because flows are decent. The festival season so far has been good. There are more upgrades on earnings than downgrades. Management commentary I think is robust. Banks are looking okay, and the large cap stocks have become cheap. So that will define the restrictive downside. So it's a easy market to call. It may not be easy market to trade. Now you can call the market and you can trade the market. If you are a trader, you would say that I look for momentum. The momentum could be there on the upside, the momentum could be there on the downside. But right now the momentum is not there. So I can predict what will the market do. But when you are in such a tight, narrow range, you don't want to trade. I mean, benchmark indices are not giving you any real reason that you should be trading. And I think that again should be a better strategy.
Right, absolutely. But in the near term, could auto sales, which are largely above, barring a few odd exceptions like Hero MotoCorp, which was in line, and perhaps sub what the street was anticipating for an Aisha Ari, Ashok Leyland or Tata Motor CV, it's been all an above estimate set. Could it be that, or could it be the GST collections, which have seen a 13% jump up, the second highest it's been on record ever, thanks to the festive demand surge?
So, GST progressively is moving higher.
Yeah.
It is not the highest ever, but GST, then see the trend is in tax
Upwards,
collection is
yeah.
upward. So I don't think this has come as a surprise or as a shocker. It's not a market moving number. I think auto is important simply, Aisha, because A, auto stocks have had a good year.
Yeah.
B, a lot was anticipated in terms of auto because of this entire seasonality which is at play, that Dussehra this time was in October and Diwali this time is in November. Now what we are looking at are numbers for example, what the companies have dispatched, which means that if let's say a Maruti and a Tata Motors, they've reported a 10% year-on-year jump. That's Maruti on a large base. Tata Motors 7%, Mahindra and Mahindra 8% month-on-month. That just tells you that they are quite excited about where they feel that the demand in Dussehra has moved and where the demand in the Diwali season would move. Aisha, because if Dussehra sales were not strong, then your October dispatch numbers would have not been strong. Then that would have led to inventory built up and companies would have cut the production down. The fact that they're dispatching more vehicles, almost double digit month on month, it just tells you that they are quite reasonably confident about the November demand. Now from a market standpoint, I think it's Hero MotoCorp, which would be important because that's where surprise has come in. Mahindra and Mahindra, the numbers were expected to be strong. Maruti numbers were expected to be strong. So if you are looking for a surprise factor in terms of a stock market reaction, well, it really should be for Hero MotoCorp.
Okay, there you have it. That's really the key takeaway with respect to the auto sales numbers and the GST collections. Time to put the spotlight on earnings because you've got Tata Steel, that's been a bit of a miss, but largely on account of that exceptional loss. Otherwise, the India business has been resilient. And then there were loads of other heavyweights. You had Hero Moto, inline set of numbers, ditto when it came to Britannia, where the revenues were impacted a bit by the low volume growth. And Sun Pharma, the Revlimid sales did manage to aid growth. What do you think, Nikunj, is going to be the big talking point or the big market moving number today?
I think Tata Steel numbers are bad.
Clearly, yeah.
I mean, they are bad on all accounts. Europe's not done well for them. India is not doing well for them. It was widely anticipated that things for Tata Steel will start improving, at least on the domestic front, largely because of what was happening with their entire, coal prices. But looks like there is a drop in realization, and which in a sense is going to be a challenge going forward. So, markets have had this very divided view on steel. The general view has been that, okay, China is not coming back, you should not buy steel. But the domestic demand, I think, has been far more powering, and a lot of market men actually have been bullish on Tata Steel, Jindal Steel, the entire steel space, so to speak. So Tata Steel may not be depicting the true picture of what is happening in India because it has a European business, but these numbers post the call. I think the call will happen during market hour. I think that's what I understand. The stock is going to correct rather than go higher. I don't think in the near term markets will give benefit of doubt to Tata Steel, at least post this performance.
Yeah. like someone said, no disco in Tisco. But in the meantime, brokerages are still upbeat. I mean, they're flagging off how weak the numbers have been, but CLSA continues to maintain its outperform with a target price of 145. But yeah, huh?
The call is not done.
Yeah, the call
is not done. They will come
Maybe
up with
they're
a
gonna
downgrade.
revise.
Exactly. They'll have to wait for
Yeah.
commentary. So
No,
they'll have
because
to
the
come.
commentary about what the report is entailing is all about losses in Europe have increased sharply. India-Europe business weaker than expectations. Q2 numbers below estimates, but they're maintaining outperform.
Yeah, so I'm saying typically how analysts would act or react, they actually would wait for the conference call and then they will get a view. So what CLSA report is saying, that you're right, that I was discussing this point with Samit in the morning also. The general view is that you wait for the call and then you come with the upgrade. Based on these numbers, you cannot have an outperformer rating.
Exactly.
So the stock, if you're asking me for one big casualty post in this earnings season, or let's say in this week, I think would be Tata Steel post these numbers.
Yeah, absolutely. Oh, in the meantime, Cognizant as well, they've highlighted the Q4 revenue guidance. It will just come up for you on your screens, and that's much lower than what the market as well was anticipating, perhaps. In the meantime, another important trigger today, India is going to be facing Sri Lanka right here in Mumbai at the Wankhede Stadium. The last time these two teams played an ODI at the venue, the occasion was the 2011 World Cup final. 12 years later, though, things are a little different. India look to continue their 6-win streak today. If they beat Sri Lanka, they will become the first team to qualify for the semi-finals. On the other hand, the case is the opposite for Sri Lanka, who will need to defeat India today if they want to continue their World Cup dream.
All right, so lots of action in the cricketing stadiums in Mumbai itself. Kush Bohra is joining in on the technicals right now. We've also got with us then Nooresh Merani. Are any of you managing to, have you got tickets? Are you going to be glued to your TV screens for today's match? Kush?
Hi, Avan. First up, good morning and thank you for having me on the show. Well, I mean, even if I did, I don't know if I could take the heat right now. The markets and the cricket combined, it's a little too much. But no, surely looking forward to the match and, India lifting the World Cup on November 19th. So yeah, there you go. That's my prediction on the World Cup at least.
Enough. So I guess you'll just be glued to your TV screens, maybe a chilled beer in hand in the AC because that's what you want. So Nooresh, I don't know if there's cricket for you, but at least for the markets, there wasn't much action yesterday. We didn't even defend 19K.
Yeah, so I don't watch cricket, but my dad is a fan, so he'll be attending the match as well as the semis, etc. So on the stock specific side, the markets are in a tight range as such. So 18,850 on the downside, 18,600. That's a band where it's tough to cross on the downside. 19,300 has been tough to cross on the upside. Now, the problem is in this range, there is no momentum. We've seen the volatility go down in the larger names. We are hardly seeing any trending moves across the board. So it's become a tough place to trade because there is not much to trade. There is not much action. At the same time, we continue to see some bit of momentum or stock specific trade is happening on the mid cap, small cap side. Also, there it becomes difficult to trade for the next 1 week because it is a result week for a lot of small caps. So there will be volatility around that. So time to take a little bit of a break in terms of trade size and wait for a better trend once we cross 19,300 or 18,600.
Let's find out then what's on Kush's radar when it comes to levels on the frontline indices. And we've been talking about this very tight range for the markets. What do you think that's indicative of, Kush?
So while we were on the subject of cricket, let me just take up, something from that parlance, where the Nifty and the Indian markets are more or less like the Australian team, down but never out, right? 18,800, 1850, this range is fairly apparent. Today, we are going to open somewhere close to the 19,200 range. I mean, 100, 150. But I won't be chasing this bounce. I'll wait for a dip in the market. I'll see if the 1900 level is held and then perhaps, look for a buying on dips opportunity. I am not too worried about the 19,000 level not being held yesterday, purely because it was the Bank Nifty expiry and we saw a lot of pressure coming from there. So it's a more symbolic thing that, the 19,000 level wasn't held. But otherwise, if you see the put base there right now, is still encouraging enough for me to say that the markets could look for support at 19,080, 900 odd levels. So after the gap up today, I will look for buying opportunities on dips. If 19,000 is held during the day, I'd place my stop loss around 18,950 and then go long for again levels of 150 and 19,200.
Let's talk stocks. Nooresh, let's quickly have your stock ideas.
So stock specific, tough to trade, but looking at two names which have shown some bit of relative strength. First is the one LIC Housing Finance, which has continued to bounce over the last 2-3 sessions. Stop loss at 450, target price of 490. Second is the Barn BPCL of swing high after a long time. Looks like a reversal in play. Stop loss at 350, target price of 380.
Kush, what about your stock strategies?
A couple of them from the FNO space. Granules looks strong. The stock was actually forming a very strong base at 325 levels and has rebounded smartly and sharply yesterday. So I think this momentum could very well continue. 345, 355 are the levels that I'm looking at in the near term. But 325 is where I would place my stop loss. The second pick is Persistent. Again, the stock's actually been on a phenomenal run, and this should perhaps continue for at least a couple of 100 points. So in the near term, 6290, 6375 are my targets on Persistent, and 6100 is where I would place my stop loss.
Have it. Those are our chartists running us through their top trades. Now, stocks to watch and what's on the editor's radar. Anisha is here to discuss just that. Let's pick out the first stock then, and Natco Pharma, Form 483 with 8 observations, Anisha.
Yeah, and quite a few of them actually do sound serious. Yesterday itself, we had seen a bit of a reaction on Natco Pharma stock. Maybe it'll see a bigger slide today. So there's a 27-page 483 that US FDA has actually issued, and 2 of them are serious. The other 2 are moderately serious, and the rest of them are a bit benign. The serious observations are largely regarding equipment not being cleaned and maintained to prevent contamination, and that's a big red flag as far as US FDA is concerned. Even the responsibilities and procedures of QC unit are not in writing and not followed. Again, a major red flag as far as US FDA observations are concerned. If this kind of observation does come through, the facility either goes into OAI or import alert. Official action indicated is, of course, the lower category, and import alert is a higher category. If it's OAI, the production can continue as far as the approved products are concerned. But if there's an import alert, there could be an earnings hit to the tune of almost 15%, and that could be a bit more critical. For the saving grace for Natco is that Kothur plant does not have any critical pipeline product launches lined up. So at least in terms of going forward, there's no big drug that takes it. And as far as Revlimid production is concerned, it's a multi-site production that they do. So even if there's a reduction of production from this facility, maybe they can catch up in others, but definitely a big red flag. And we have seen these US FDA issues cropping back. Even though earnings have been strong, Nikunj, this is something that nobody can anticipate for a pharma company.
So, Natco has this unusual pattern in terms of the volatility in the earnings. Like pharma companies which have a product pipeline which tends to be much more stable, and the cyclicality is not there. With Natco, I think that's not been the case. I mean, they got re-rated during COVID because of the product portfolio they had. Then the Revlimid launch helped them. Then the COVID portfolio, they had to write it off, and this has been a comeback year. But for Natco now in the near term, if the import alert becomes a challenge for new product launches, then what happens to FY25? What happens to FY26? So the existing product portfolio will do well, where markets have already captured that upside. But then what happens in the near term to the future pipeline? Until the time these problems are not resorted, we've seen that, even for that matter, even cases like Ipca, or for that matter, Lupin or Cipla, when these challenges of US FDA are not sorted in the near term, that really tends to jam the future pipeline. If the future pipeline gets jammed for a stock like Natco, which otherwise has a lot of cyclicality to its earnings because it's a very niche pharma company, then FY25, FY26 estimates, in a sense, will be hunkered down.
Yeah. Anisha, not surprised, a cut in organic revenue guidance from Cognizant?
That's been the case with most of the IT companies, pretty much become the norm. And yeah, that's why we weren't surprised by the kind of guidance cut that has come in. In the coming quarter, which is the fourth quarter for Cognizant, they're talking about a decline of anywhere between 2 to 4%, almost 1.2 to 4% in terms of constant currency. And even if you look at the full year guidance, they're talking about that the number is either going to be flat in FY23 versus FY22, or there could be a decline to the tune of 0.7%. The operating margin guidance, however, has been brought towards the higher end of the range. It now stands at 14.7%. Having said that, if you look at this quarter's number, they weren't ugly. Yes, they were definitely muted, but largely in line with what Street was expecting. The constant currency declined by 0.2%. The operating margins have also slipped a bit, 15.5% versus 16.4%. But the good news is that the bookings continue at a decent pace. Bookings has actually jumped up by 9% on a year-on-year basis, taking the book-to-bill to almost 1.4 times. And even if you look at the headcount, it's been a decent addition. There's a bit of a worrying factor coming in from the commentary, wherein they're saying that the level of uncertainty is probably higher right now than it was a few months ago. But Nikunj, IT as a whole hasn't done much this year, but it hasn't been beaten down as well. I mean, if you look at the valuations, it's not like these stocks are available at a fire sale. They're still above or very close to their 5-year averages.
But the growth is nowhere close to its 5-year average, right? So I'm looking at a sector where the order books are large. And one thing I think we've realized this year, at least that's been a realization for me, is that order book is not translating into revenue. You would imagine that, okay, order book is here, and these are not infra companies where order book comes and there is a delay because of other factors. These are order books which are coming to IT companies from US companies or European companies. Order book is coming, but that is not translating into revenue. That's a concern. Second, if valuations are still above their 5-year average, but growth is nowhere close to its 5-year average. Imagine for a sector which always has expanded, irrespective of, barring 2008 or barring 2001, I guess for the first time in 20 years, barring these 2 years, the sector is actually contracting. And it's a contracting sector where growth is just not there. So at a time when the market is giving options to look at sectors, banks for that matter, they're growing at 15-18%. You've got consumer companies which are growing at 7 to 8%. You've got pharma, which in a sense is making a comeback. So the choice is that whether you want to go for a sector where there is no growth and a potential comeback in the second half of this year. Well, for that to happen, the valuations have to become very attractive, and you're not there yet. So either growth has to come back or valuations have to become attractive. So like this Hindi terminology, Trishanku, the sector is stuck right now. No growth and higher valuations.
But do you think there is scope of any further re-rating, or do you think this will, at least for the next 6 months, continue to be like the status quo, trying to balance it out? Because this is the first time, in 20 years, we're talking about a headcount reduction at the industry level, and this is very important for India, given the fact it employs a lot of people and has a ripple effect across sectors and segments.
See, what is good about IT? Companies are cash rich, balance sheets, they are doing buybacks and dividends. See, the return on equity and return on capital is actually north of 20%. And if US economy is growing at 4.5 to 5%, the sector will come back. So what we are discussing, what we were discussing in 2021-22, like a digital sugar rush, versus what we are discussing right now, it's almost end of the journey. 6 months from now, 1 year from now, we could be discussing a reversal. But that 6 to 8 months, I'm not so sure whether you will actually make a lot of money till the time that visibility will not come back. See, I'll tell you what, some markets always preempt growth. They always vote for rate of change. But in this case, because IT in a sense has disappointed and the commentary is not kept in terms with the delivery, what IT companies have indicated, markets would wait for actual execution and then they would visit these stocks. And I think that is still 6 months away. So this time IT stocks are unlikely to rally in advance. They will only rally post the numbers.
Okay, that's IT in the spotlight for you. Thanks very much, Anisha, for highlighting Natco as well as Cognizant. Time for a quick break. We continue to chat stocks and news and lots more with our market experts when we return.
Back with the market right here in ET now. Lots of stocks and a lot of sectors to focus in on. Unfortunately, there's a big respite post the Fed meet out of the way, and you are seeing the GIFT Nifty as well. The implied open indicating an 0.8% uptick for us. Of course, Triveni Turbine, LIC Housing, JK Tyres have been all good numbers, but big disappointment coming in from Tata Steel. Natco, we just flagged off, got a Form 483 for their Kothur formulation unit with 8 observations, some of them being very serious. And then KEC as well, which has fallen short of expectations. Let's discuss all these themes. We've got Sanjeev Bhasin joining in on the show right now. Sanjeev, hi, good morning. Pretty much along expected lines, the Fed event out of the way. It's a pause once again, and seems like we're in for a snapping the range, which we've been stuck in for the last 3 days, and finally see some meaningful uptick.
Yeah, good morning, Aisha. That is what we were suggesting yesterday in your studio, that bond yields have peaked, and most of the event discounting was taking place with the markets having been on a weak note. I think the Fed was extremely dovish, and he's indicated now that even though there is no chance of a rate cut, there is no chance of a rate hike. And yields, Aisha minded, if yields trade 10 basis point lower, below 4.65, the dollar will weaken and there will be a flurry of ETF flows back into emerging markets. We've seen that in Japan. That's a developed market. But I'm very, very optimistic given that Eurozone yesterday recorded the lowest inflation in last 2 years. So I think banks, credit lenders, and the whole proxy of credit expansion because of festive season should do extremely well. So I am looking at this range breaking today itself, that 19,250, 300 on the upside. And then we chart our way towards a very sparkling Diwali by next week.
Okay.
Right.
All right, stay on with us. So we have to take a quick detour and put the spotlight on IGL. We've got Kamal Kishore Chatiwal, who is the Managing Director of Indraprastha Gas, now joining in. Thanks so much for taking time out. To begin with, your volumes in Q2 have been around 8.3 MMS CMD, and your FY24 guidance was a little bit more. How are you seeing volumes picking up in the second half?
Actually, the quarterly MMS CMD volume is around 8.3, as against 8.09 that we had done last year. So going forward, we see in this quarter, if you see, there have been quite disruption, 2 major disruptions in the form of G20 as well as the floods in Delhi. So that has impacted around, you can say, 8 to 9 days of sales. And the impact of that is around 0.12. So we are hopeful that we will end the year at 9 MMS CMD.
Right. Kamal, have volumes also picked up in the current quarter?
On 27th of October, we have clocked the highest ever sale by IGL of 51.92 lakh kg per day. And earlier, we were just touching around 50 lakhs due to this festive sale and plus some of the initiatives that we have taken to increase our dispensing capacity. So we have been able to achieve around 52 lakh kg. And if you see our last annual, that was around 46-47 lakh kg. So there has been an increase of 10 to 12%.
And has the car conversion rate improved? Are we hitting the earlier mark of 16 to 17,000 per month?
Yes, that has actually picked up to 17,000 in September. However, in October, it has again come back to 16,000 or so. So we are in the range of 15 to 17,000. And NCR region, especially Gautam Budh Nagar, Ghaziabad, we are seeing huge conversions there. And we expect this to continue. And the rate is around 25%. The growth of conversion is in 25% range.
All right. And in the first half, your margins remained around 8.6%, which is higher than the guidance that you had given. Will your margins sustain? Are you upping the guidance, or will you be taking any more price cuts to make the CNG more attractive?
In some of the GA, you are right that we will be taking some price cut in the GAs, say, for example, Rewari, Karnal, where we can take some cut. But in other GAs, we expect to maintain the same margins. And one thing you have to factor in that we have been able to maintain our margin despite input cost increasing. As you are aware, the cost of both APM gas, the HPHT gas, has slightly come down, but our LNG prices have gone up, as well as our allocation of APM gas has gone down slightly.
And owing to the government's renewed focus towards EV adoption, what percentage of your volume is at risk?
So, if you see in Delhi, we have around 2 lakh registered vehicle aggregator with the aggregators. So, out of that, we sell around 10 lakh kg per day. So as we understand from the policy that has been approved, so in 5 years' time, the new additions will be converted to 100%, and by 2030, this 100% aggregator would be converted to electric. So we have 5 to 7 years' time, and 40% of our volumes comes from passenger vehicle, where we see a demand of that. So you can say that with aggregator policy, we expect around 10 lakh volumes by 2030 to be impacted. But at the same time, the Delhi government, recently the new vehicles purchased by these aggregators or the taxi operators, so they have given a approval for running these vehicles for 15 years. So there is a bit of clarity required whether those vehicles which have been approved to be on roads for another 15 years, what will happen to them once this aggregator policy is implemented. So that clarity maybe we are also asking from the operators as well as the aggregators as well as the government, that what will happen to those taxis.
Sure. But are the targets set in the policy realistic, and do you expect these to be implemented successfully, given that a large part of the Delhi-run cabs are registered in Noida and Gurugram? Also, the infrastructure is yet to be developed.
Yes, that is one point, but we have factored in within our strategy that going forward, Delhi and NCR is facing a pollution issue. So we are factoring in that going forward, this pollution from this, what EV does is the shifting of pollution from congested cities to elsewhere. So that we expect it to continue. And implementation is one issue that going forward would be a challenge. But we will be supporting the government in the initiatives because we stand for cleaner fuel. And in that respect, we feel that one of the guidelines of CAQM has been that from November 1st of November, all the buses entering Delhi are to be only CNG, EV, or diesel of BS6 make diesel buses. So we have been in discussion with the various state transport undertakings, because recently today Haryana has informed us that their 600 buses have been affected. Uttarakhand had earlier informed that 500 buses have been impacted due to these guidelines. And similar numbers would be there for other state undertakings. So we are seeing that within the city, maybe the public transport would be electric, but intercity as well as for NCR cities, satellite towns, we feel that it would be on CNG. So we are trying to address the issue of state transport undertakings. We are meeting their heads and giving them solutions regarding conversion to CNG.
Right. But given that you have more than 1,500 crore rupees of cash in the books, how is it that you're planning to deploy this? Any acquisitions to fuel growth, perhaps?
So we have kept some amount for, inorganic growth also. So those opportunities, as and when they come. So we are open to that. In addition to that, we are working on some of the initiatives for diversification from other businesses. So these are the two areas we are working on, and inorganic opportunities will definitely come. We are hopeful that in near future, some would be available to us.
And finally, is there anything that you're evaluating at this moment?
No, as we have stake in some of the GAs. Say, for example, CUGL, we have 50%, MNGL 50%, and some of our parent companies also has some stake. But as of now, we don't have any such offer. So we are, in fact, if any offer comes, we are open to that.
Right, Kamal, great to have you on the show. Thank you so much for taking the time out and, clarifying a whole host of issues that the market was, pondering about. Let's move now from one quarterly earnings to the other. We've got the management of Sirma SGS joining in right now. JS Gujral, the MD, joins us on the show. Mr. Gujral, great to have you on the show. Thank you so much for taking the time out. Extremely strong revenues, and I guess that's been led by the consumer segment, while the health and the IT segment are still seeing a fall. Tell us a little bit about what's impacting your revenue, and what is it that you plan to do for higher margins in the health business going forward?
Thank you for calling me to the earnings show. We have been witnessing strong revenues quarter on quarter, and with the corresponding quarter of the previous year, we have been growing at about 45-50% plus. And we expect this trend to continue. That's number one. The mix within the revenues by and large remains the same, except that the consumer segment is growing at a faster traction than the other segments. Automotive is stable at about 24-25%, industry at about 25-27%. It's the consumer sector which is growing at about 34%. It's accounting for 34% of our revenue. We expect the second half, as has been in the past, to be better than the first half. Typically, the first half accounts for about 45% of our total revenues, 40 to 45%. So based on this, we are on track to achieve what we had targeted for the current year. Now, on the margin profile, the way we look at is that, is the margin increasing or declining in every segment which we service? And for us, the satisfying part is that the margins in the segments are either increasing or remaining stagnant, except in the consumer segment. Last year, the consumer segment was primarily based on our own design manufactured products. And this year, it has come into the OEM or build to print segment. And hence, in the consumer segment, if we compare with last quarter or quarter on previous quarters, the margins have shown a decline. That's because the nature of the business in the consumer sector has changed.
So I just wanted to come in here and talk a little bit about healthcare, which has been subdued in the past couple of quarters. When can we see an improvement?
This quarter, the healthcare compared to Q1 has shown almost 100% improvement. As I shared in my last call, the healthcare in the Q1 was only 15 crores. This year, it is twice or little more than that. And this trend, I think, will continue in the coming years. The margin improvement, which is a point of concern or point of concern for all, is going to be rectified in the coming quarters as we go more into exports. Exports currently account for about 27%. And in the last call, I had shared that we had onboarded some major global clients. Those clients will go on stream in Q1 of calendar 24 or Q4 of FY 23-24. So I expect the absolute figure of exports to go up reasonably in the coming quarters, though as a percentage of the sale, they would again be sub 30% simply because the domestic market is growing at a much faster pace.
You hope to get back to those 11 to 12% kind of range when it comes to your margins?
That's a long haul, not in the short run. But definitely, we are currently sitting at operating a bit of about 7%. I think in the coming quarters, we'll see an uptake on that. And with the operational efficiencies which will set in, for example, compared to the last year, my operating overheads have gone down by about 4%. And H1 being a subdued sort of half year compared to the H2, I expect this saving to get magnified in the coming quarters. The growth is very bullish. Our capex plans are on track. And I'm happy to share that we have signed up with one of the largest, if not the largest, IoT module manufacturer in the world. and we see significant business coming in from that. And this IoT module has a application across industry segments, whether it is in the energy metering, whether it's in telecom, whether it's in consumer. So we're very bullish and confident of growing at a pace higher than the industry. Working capital is under control. Margins are the only area which we have been sort of lagging in recovering. The other two legs which we had set out, they are on track. And so I expect in the coming quarters, this would also improve. And this will be aided by your design and engineering setup, which we commissioned in April of this year. Early days, it's into the incubation and it's started giving some revenues, but I expect it to significantly scale up in the coming quarters, more so in 24-25 FY.
All right, sir. Appreciate your time. So glad you could join us. Good luck for current quarters. Markets, well, can the bulls really, come out of this slumber? Bit of a boxing match right now is happening where one day belongs to the bulls, the other day belongs to the bear. Bottom line is that the market may look volatile, but it's an easy market to call because it's not headed anywhere. But as you walk into trade this morning, let's assess risk for you. Yields have come down from almost 5% to 4.7 to 4.7, shade below 4.8 actually. So 10-year has come down. US markets have rallied and SGX is indicating that we could be in for a solid start. Hemang Jani, could today be the turn which everybody's been waiting for? The GIFT Nifty is indicating that we could be in for a strong gap up start of 150, 170 points.
Yeah. Good morning, Nikunj. I think, see, what do markets want for some stability and strength? You need some sort of support coming from the earnings side. And earnings season, by and large, if you see, has been quite good. In fact, in the Nifty level, it's slightly better than what the market was expecting. And also, you need a little bit of support and stability in the global markets, which have not been coming through for a while. So we have some relief come through from the global markets. And it looks like that at least for the near term, the possibility of a rate hike is out of the way. So I think we are in for some sort of a relief rally. Now, how long that rally will continue, which pockets will really contribute to that, that is something that we will have to really figure out. But I do think that there is a case for a good amount of rally, the index and certain mid-cap stocks also.
Hemang, morning. What do you make of Tata Steel's earnings? Seems to be weak across the board. Yes, there was that exceptional item this time around, but on all parameters, be it the operational performance, the revenue growth has been lackluster. What does this spell out for Tata Steel even in the coming quarters? Will the pain continue?
It looks like the Europe continues to be a drag for Tata Steel, and the kind of impairments that they have taken at the UK facility would have some sort of an overhang on the stock performance. And we have to remember that China being a big economy for the metal, not doing so well, and a bit of a concern on major other markets will have some bearing on the outlook for a global play like Tata Steel. I think in the near term, at least, it would be best to really leave this space because of the kind of, erratic data points that we are seeing.
I want to go back to banks again. And Nooresh, are we at that turn for banks now? Because if GIFT Nifty has to go higher, it has to get support either from Reliance or HDFC Bank or maybe both.
So, see, we may see a 1 day, 2 day move as of now on a lot of these banks because they've corrected. So if you look at HDFC Bank, it's back to 1450 to 1480 band. Even ICICI Bank, which used to be a leader, is back closer to 900 level. So a 1 day, 2 day bounce, but it's only when we start crossing 43,500 on the bank Nifty where the trend changes. The same is the case with, say, a Reliance. If it crosses 2350, 2370, the trend changes. So for now, the trend change levels are, say, at least 5% away. So it looks like a 2-3% bounce as of now in most of these heavyweights. But can we go beyond that? It's still a question mark.
Okay. I'm going to just change gears and talk about IT. Hemang Jani, Cognizant is talking about no growth. And I don't remember when did I hear this. I think must be 2008, when IT companies had a year of no growth.
So Nikunj, what is the question?
Yeah, I mean, I'm surprised. Aren't you surprised? With Cognizant, beginning of the year, 10% growth, now no growth. 9 mahine mein, everything is gone.
So Nikunj, actually it does not surprise us because if you look at TCS, last 3 quarters they are reporting flattish growth. Now the analysts are talking about 8 to 10% growth for FY25. So market had started pricing that in much before. If you recall, last 1.5 year, IT index is underperforming, and so which means that the market is far more smarter in factoring in slowdown or major trends. So I think market has already priced that in. I think what we have to see is incrementally, are there any kind of data points which will suggest that the hiring is back, the technology spend is back, because that is what will give you a good amount of a delta play, because the risk reward is in favor. You really need some trigger that could really give you some kind of a growth. So I think you can't be negative on IT at this point. But yes, you really need to watch out for good triggers and should look out for buying opportunities.
Okay. Kush, some stocks which are clearly patronized by traders. Vodafone Idea, 50% up this year. JP Twins, which is JP Associates and JP Power Ventures. What's your outlook on these three stocks?
Start with Vodafone Idea, where the stock's actually in a zone where spent some time. There was consolidation, so 10.5 to about 12.5 was the range where it spent a lot of time. A lot of hope pinned on it. I think it could perhaps go the Suzlon way, where a lot of traders weren't really too keen, rather than a trading position on this. I think once it's crossed this 12.5 mark, I think there is some upside that could come into this stock. I won't be surprised to see 15 plus kind of levels in the near term with the kind of news flow and the price action that we are seeing. So not a bad idea to perhaps have a positive trade on the Vodafone Idea stock. The other two somehow I'm not been able to track very actively, Nikunj, so you'll have to excuse me on those.
What's your view, Nooresh, on JP Twins, JP Associates, JP Power Ventures, purely on charts? I mean, I'll keep the fundamental, I'll keep the I'll keep the entire view on the sector aside.
So the best way to trade some of these names is to remove the chart name from the chart, because given the history of association with the stock price as well as the name, if you look at the short-term charts purely on a technical basis, we've hit almost a 2-year high on the stock. The last time the stock was around this 14-15 levels was in June of 2021. And over the last 2022-23, every time the stock came to 12, it topped out. So clearly a breakout done technically above the 15 mark. Volumes have been highest in the last 6 months. So out here, the only case is one has to keep a risk reward stop loss below 14 and actually expect a move towards 20-25 levels also. So Jaiprakash Associates looks interesting. Same way Jaiprakash Power also. 11 has been a top for the last almost 2 to 5.
Okay, real estate. Across the board, real estate stocks have been riveting. DLF numbers, you cannot find a fault line there. DLF this year is up 50%. Bohra Realty, 34%. Excuse me. Prestige, same movement in terms of the price action. There you go. I mean, these are bumper gain, guys. These are bumper gains in some of the real estate stocks. Hemang, is it too good to be true?
I think Nikunj, last almost 2 years, if you look at the real estate in terms of the fresh, sales, registrations, the kind of new projects which are being announced, the improvement in the balance sheet when it comes to real estate companies, even the commercial side of it, the yields and the traction seems to be improving. So a lot of things are going for this sector. I don't think if you look at Mumbai, the kind of AQI and all, we are of course worried about all of that, but that shows the kind of traction which is there when it comes to construction. I think this is a theme which will continue despite higher interest rates. I think the growth has continued, which has surprised many participants. But yes, in terms of the price moves, because it has already happened, I would be more comfortable buying into a DLF or an Oberoi or a Lodha at a 10 to 12% correction. But if you are a momentum player, I think you should definitely go with it.
Hemang, what within autos looking appealing, given that most of the earnings are out of the way? For instance, Hero Moto as well, inline set of numbers. The management is talking about consumer confidence coming back.
I think what has really surprised me personally is the way the two-wheeler numbers have been out. And this was a space where people had a slightly negative view that, okay, the growth is not going to come through. But if you look at the performance of Hero Motor, TVS, and Bajaj, of course, it's mind-blowing. Even Maruti numbers were good, though the stock has slightly muted reaction. I think auto as a space should do well. If it cools off, surely it will present a great opportunity because the numbers, both in terms of quarterly performance and the festive season sales, showing good traction.
Kush, Tata Motors, the star this week. Numbers are today. Is there trade ahead of numbers for Tata Motors?
There most certainly is, because the stocks actually just come down only with the market correction or the profit booking that we've seen in the markets. But if you see for the last 4 or 5 sessions, there's a very clear base formation happening at around 625 levels, so very close to support zone, not giving way beyond the support zone. So I wouldn't be surprised that from here on the stock actually jumps up, continues from where it left off. In fact, the last time around, the stock actually gave a breakout was from these 625, 630 odd levels. So for me, an upswing here is very much due. 640 is the first level that I'm looking at. Once that is taken out, 665, the near-term highs is perhaps what the stock could retest. On the downside, a very clear stop loss at about 610. So there's very clear base formation. I think the stock's just waiting for some sort of a trigger to move high.
All right. Meantime, let's also get in a sense as to what the outlook is on some of the stocks that are on the brokerage radar as well this morning. Remember, a whole host of numbers as well did come out. So Tata Steel, you've got CLSA maintaining that outperform stance with a target price at 145. Godrej Consumer as well came out with their numbers, and CLSA has downgraded the stock, saying that the lower volumes in India have been partly offset by the international growth. They've also slashed the target price to about 930 rupees. Britannia is on the brokerage radar. JP Morgan has a neutral stance with a target price at about 4,900, saying that the revenues have been a miss for Britannia, but it's been better than expected margins that have driven an earnings beat. Hemang, your take on consumption?
Numbers have not been exactly great. If you look at HUL, the volume growth was hardly about 2%. Britannia, again, a bit of a disappointment on the top line front. Of course, margin expansion is something which is surprising everyone as to how exactly companies are reporting 400, 500 basis points, improvement in the margin. But the fact of the matter is that the rural side is definitely a pain point. And the valuations are not exactly cheap. So when there is a risk appetite prevailing, people may want to hide behind some of these names. But in terms of growth versus valuations, I would not consider this as a great space to be in. So for the timing, and avoid for me.
Okay, that's the view coming in on the entire consumption space. In the meantime, let's also get in a take then on some of the stocks that were active in yesterday's trading day within the broader universe. Despite the fact that it was fairly lackluster, select stocks did manage to stand out in trade. So the likes of a Vodafone Idea, that's something that Sanjeev Bhasin has been advocating. Blue Star as well was a buzz, a solid 7.8% or so. Indus Stars gained traction in trade. Birla Soft was another newsmaker, came out with numbers then later. You also had SIS as well as something like a Phoenix Mills. Speaking of Phoenix Mills, Kush, wanted to get in your take in the entire real estate space. If you had to cherry pick a few winners that look good for a buying opportunity at the current level, what makes your list?
So Phoenix Mills, just because you mentioned this stock, let's start with that. Not a bad idea at all to get into this. Very clearly the rebound on this one has been very sharp. Came down only with the market profit booking, but otherwise the rebound's been very sharp. I won't be surprised to see 2000 plus kind of levels retested on this, the recent highs that it made. So Phoenix Mills would definitely make the cut. The other stock on my radar from this space is Prestige Estates. Very similar story here. The stock's actually gone into a bit of a consolidation phase, which is a good sign. Nice, levels to accumulate here. On the upside, we're looking at 810, 815 kind of levels. On the downside, 725 is a very strong support zone, and it's not a bad idea when we're talking about the entire real estate space to look at some of the ancillary names also, the likes of Serra Sanitary, where right now in a bit of a downturn, but coming close to the support zones of about 8,000, 8,050. So not a bad idea to have some of the home improvement themes also on the radar.
Okay, fair enough. That's the view coming in on some of those real estate stroke home improvement stocks as well. Just about 30 seconds to go for the pre-open rates. But in the meantime, we've got Mr. Saurabh Chawla, who's the ED Finance and Strategy at GMR Group here on the show to talk about the performance for the quarter gone by. Thanks much for joining in. How has it been across your segments, your aero, non-aero? Will the second half be substantially better than the first, given the festival season?
We really don't give guidances on numbers, but sure, from a passenger growth trends, we are above the pre-COVID levels, and there is good tailwind as far as traffic is concerned. Q2, the traffic would have been better, but for the G20 meeting and also on a seasonality basis, Q2 is always a slower month, a slower quarter. But in Q3, as the holiday season kicks in, traffic from Europe and US also picks up. We expect a pretty robust growth on traffic. There is a significant tailwind as far as the airport sector is concerned. There are certain capacity constraints, but those are at the airline level. As you're aware, GoAir had financial difficulties, so they are not operating right now. But the good part is with Air India privatization and key focus now coming on expanding and improving their services, we expect in a medium term robust growth from both Indigo, Air India, and when I talk about Air India, I'll talk also include Vistara in that, being part of the same Tata group. So I think airport business is very well positioned as we speak.
So on the non-aero revenue, what is the outlook and what is strategy going forward to take the revenue to a faster clip?
The revenues will grow at a faster pace than the passenger growth, and that's because of the fact that currently we are running between $11 to $12 per passenger spent at the airports. And as I said earlier, as disposable income goes up, as we offer far more better brands at our airports, people will tend to consume at our airports. We want to take this $11 to $12 spend per passenger to, let's say about $15 in the medium term. And that will surely give better revenues and better margins to our airports. So I think the non-aero side of the business is the cream on the pudding, and we are very happy as to how this business is developing.
So when is the tariff revision for Delhi and the MOPA expected, and what is the status on that?
In MOPA, we expect that the new tariffs or the first control period should begin in Jan. The consultation paper has been put for public scrutiny, and that should happen in coming Jan 2024. With respect to Delhi, our capex is getting completed during this year. We expect to file for the new control period, the new tariffs by end of December, January. And hopefully, I think within the next fiscal year, which is fiscal year 25, we should expect the new tariffs to come into play at Delhi. That's the timeline that we are expecting.
Also, a brief on the progress of capex at the Hyderabad and Delhi airport. What are the expansion plans there?
So I think more than 95% capex has been completed, both in Hyderabad and Delhi, and it will be fully completed within this current fiscal year. Bulk of the work is already over. It's now only small spends. So physical work is more or less completed. Financial spends, of course, come with a little lag when you release the payments. But by March 31st, everything will be fully completed and sealed.
Mr. Chawla, really appreciate your time and thank you for joining us. All right. Two stocks which are worth revisiting. One is Natco and second is Cognizant, purely based on news and what we should expect today from them. Order book is not translating into revenue. You would imagine that, okay, order book is here, and these are not infra companies where order book comes and there is a delay because of other factors. These are order books which are coming to IT companies from US companies or European companies. Order book is coming, but that is not translating into revenue. That's a concern. Second, if valuations are still above their 5-year average, but growth is nowhere close to its 5-year average. Imagine for a sector which always has expanded, irrespective of, barring 2008 or barring 2001. I guess for the first time in 20 years, barring these 2 years, the sector is actually contracting. And it's a contracting sector where growth is just not there. So at a time when the market is giving options to look at sectors, banks for that matter, they're growing at 15-18%. You've got consumer companies which are growing at 7 to 8%. You've got pharma, which in a sense is making a comeback. So the choice is that whether you want to go for a sector where there is no growth and a potential comeback in the second half of this year. Well, for that to happen, the valuations have to become very attractive, and you're not there yet. So either growth has to come back or valuations have to become attractive. So like this Hindi terminology, Trishanku, the sector is stuck right now. No growth and high valuations. What is good about IT? Companies are cash rich, balance sheets, they are doing buybacks and dividends. See, the return on equity and return on capital is actually north of 20%. And if US economy is growing at 4.5 to 5%, the sector will come back. So what we are discussing, what we were discussing in 2021-22, like a digital sugar rush, versus what we are discussing right now, it's almost end of the journey. 6 months from now, 1 year from now, we could be discussing a reversal. But that 6 to 8 months, I'm not so sure whether you will actually make a lot of money till the time that visibility will not come back. See, I'll tell you what, some markets always preempt growth. They always vote for rate of change. But in this case, because IT in a sense has disappointed and the commentary is not kept in terms with the delivery what IT companies have indicated, markets would wait for actual execution and then they would visit these stocks. And I think that is still 6 months away. So this time IT stocks are unlikely to rally in advance. They will only rally post the numbers.
Okay, while we're bracing ourselves for a nice rebound in the markets today, let's address what's looking interesting within the mid and small caps. Kush, what mid-cap stocks would you recommend?
One stock that's been on my radar for a while and continues to outperform is Kirloskar Oil. The stock's been in a stupendous uptrend, if you see, since the beginning of the year, and actually just keeps on gathering momentum. At every dip just turns out to be a buying opportunity. So again, it's a good idea to hold this for the long term, even after such a stupendous run. But if you're looking for a trade, then not a bad idea to hold it for 575, 590 kind of levels. In the near term, 545 is where I would place my stop loss.
Nooresh, what about your mid-cap strategies?
So that would be a risk-reward trade on RBL Bank, which has corrected from 250 odd levels. Every time over the last 2-3 months, it has found support around this 215 mark. So a risk-reward trade here, stop loss at 214, target price of 245.
All right, and Hemang, finally, let's get in a quick take from you then as to what the outlook is when it comes to the entire pharma space.
I think there is some amount of comeback, particularly when you look at the Cipla and Dr. Reddy numbers. Definitely, it is giving you a certain degree of comfort for the companies which are focusing on the overseas market generic opportunity. So I think both of these companies should do well. Sun Pharma is a mixed bag, nothing really great in terms of positive trigger or surprise. But I think broadly the sector is coming back, and we should have a certain amount of exposure to the large cap pharma.
All right, there you have it. That's a view coming in from Hemang. Good to have you on board. Thanks so much then for joining in. Lots of other headlines then that we're tracking outside as well of the business world. LinkedIn, actually, the business-focused social media platform owned by Microsoft, now has more than 1 billion members. Crossing the 1 billion users mark puts LinkedIn in the top tier of social media networks that include rivals like Meta. The company is also adding AI features for users with a paid subscription on the platform. Meantime, a series of heavy airstrikes targeted largest refugee camps near Gaza for the second consecutive day, with Israeli forces advancing towards the city's residential areas. Meanwhile, hundreds from the Gaza continue to cross the Rafah border as civilians were allowed to leave Gaza for the first time since the war began. And Pakistani authorities have launched a crackdown on illegal immigrants, including around 2 million Afghan nationals, as the government is set a deadline for them to leave the country, which has expired. The security forces have launched sweeps to arrest and deport Afghans who are in the country without their papers, even as hundreds of Afghans were seen camping near the Pakistan-Afghanistan border.
And back home, a petition has been filed in the Supreme Court seeking a review of its October 17th verdict, in which it had refused to accord legal recognition to same-sex marriages. The petition said that the majority of judgment is self-contradictory in understanding of marriage. And there's no respite, unfortunately, for Delhi as residents continue to breathe toxic air. The air quality in the national capital has degraded further as it hovers around the very poor category for a sixth consecutive day. Several areas in and around Delhi have already reached the severe category, with AQI levels now hitting 404. And it's the 2nd of November. It's the biggest day for all SRK fans, as the Badshah of Bollywood is celebrating his 58th birthday today. And in true style, Shah Rukh Khan, the Pathan star, kicked off his birthday celebrations by greeting his fans outside his home in Mumbai, Mannat, striking his signature pose. Here's wishing the King of Romance a very happy birthday from all of us.
Okay, an absolute favorite there, SRK. I'm sure the heartthrob of many. All right, index calls then. Let's find out what our chartists are picking out as their strategies for the day. No trade, says Nooresh. Kush Bohra believes it's a hold on the Nifty. Remember, a pretty patchy day of trade yesterday. We've been in a tight range when it comes to the Nifty Bank as well, and no trade according to Nooresh, with Kush's stance remaining a hold.
Nooresh, the SGX is indicating, again I go back to that point of 19,120. This is from where we've retreated in the past. If we spend, let's say, half an hour above these levels, then is it time to punch in a buy trade?
So if we look at the major swing low, it was 19,200, 300 band, which would hold on for the last couple of months. So that is the area we could go and test. So it's a risky trade buying at 19,100. It is a forceful trade right now, because till the time we don't cross back above the previous swing lows, we could keep seeing some selling pressure around that area. So the risk reward is 1:1. So you buy at 19,100, keep a stop loss of say 50 points, expect another 50 points on the upside, or say a 70 point stop loss and a 70 point target. So the risk reward is not great. Yes, there could be some follow up given that we would cross yesterday's move, but for now, it's not a trade till the time we don't cross and sustain 19,300.
Kush, what about the reverse, that we failed once, we failed twice, we failed thrice, and we could fail again at 19,100?
That's a very real possibility, because 19,100 still has the highest call base. If you see from yesterday and today being the weekly expiry, if Nifty does not really hold 19,100 for, let's say, first 15-20 minutes, we could very well slip, below this. Although I wouldn't say, we'll go all the way back to 18,800 probably in the next couple of days. But there's a stark possibility that, we may not hold above 19,100. I'll wait for at least about 15-20 minutes to see whether, any short covering on that strike price happens. But yeah, I wouldn't be surprised to see if we sort of give away from, 19,100 levels, at least in the opening.
A minute to go. We are working with good set of global cues. When I say good set of global cues, global risk indicators are favorable. Yields are down. Bitcoin is up. US is up. Nasdaq is strong. And GIFT Nifty and the pre-open rates are indicating that we are in more for an upside. The 4.9 or 5 becoming 4.7 is a very big change. It just tells you that how the bond yields have actually collapsed. And this is happening at a time when US economy is moving and Fed has not shut down curtains they've not really pulled the curtains down on a rate hike. So markets are preempting that no rate cut actually, no rate hike and some rate cuts are coming. That's the Fed trend in terms of where they've moved. June they did not move, July they moved, September they did not move, November they did not move. The consensus is that they are unlikely to move even going forward. First rates any seconds, and I'll let the clock do all the talking. It's Thursday. It's a long series actually. The series started last week, and then you got Diwali, you got a lot of festivals this week. So it's a long November we have to brace ourselves for. First rates will just start coming up on your screen. I'll let the screen perhaps in this case do the talking. Where is the bell? There you go. First rates Thursday morning on your screen. It's going to be a lot of green on the screen, and it is surely a lot of green on the screen. The breadth is looking impeccable. Picture perfect market breadth, 1:13 in terms of advanced decline ratio. Britannia, Hero MotoCorp, L&T, Mindtree, BPCL, Bajaj Finance, Infosys. I'm picking up stocks from the Nifty in no particular order, but it is just moving higher. Tata Steel, is that the big dark red on the screen today? Is that the big dark red on the screen today? Well, it's red, but not a big dark red. I think markets are waiting for the conference call. Let's see if brokerages, they change their opinion. I thought that the casualty could be 4-5%, but 1% low for Tata Steel just tells you that it is not a very scary setup. The small cap index, and there you go. Hello again, 1.3% higher for the small cap index. So if you're looking at the real exciting part of the market, time to say hello to small cap again. Aisha?
Yeah, they're making a meaningful comeback, better than the large cap peers as always. While the Nifty now is catching up on with that 19,150 print as we speak. A lot of other earnings reactions as well. Let's see what Hero MotoCorp is up to. The Q2 numbers have been in line with estimates. Margins coming in 14%. So decent numbers there, 1.5% higher. Although the monthly sales numbers has disappointed, but the numbers or earnings for the second quarter are looking good. Godrej Consumer, we're going to be chatting with the management as well in the due course. Their Q2 also is above estimates. The gross margins have risen 700 basis points. There's JK Tyre as well. Margin expansion of 720 basis points there. KEC International, revenue uptick of 11%, margins coming in at 6.5%, 1.25% higher for KEC as well. Kansai Nerolac too came up with its numbers, EBITDA jump up of 37%. Triveni Turbine, wherein the EBITDA has risen about over 33.5%. So these are a couple of stocks which are in focus. There's LIC Housing Finance as well, by the way. Both the net profit as well as the NII are above estimates. And the gross NPAs as well have shown an improvement. We're not seeing any excitement come by on that stock. Fino Payments as well came out with its numbers. Profits have surged 41.5%. And the other income has clearly aided the P&L here, which is up 70%, 2.5% higher for Fino Payments as we speak. It's not just Tata Steel actually, but Britannia, that also came out with its numbers. The revenues actually are below estimates, so let's see what Britannia is up to in trade. But that stock doesn't seem to be in any spot of trouble, still holding up by about 2.6% as we speak. Volumes, remember, are up only 0.2% versus the street anticipation of 2 to 3%. Eicher Motors, the October Royal Enfield international business is down 39%. Total sales are up 3%. It hasn't quite matched up with the street estimate, 0.6% higher nonetheless for Eicher. And then, of course, there's Sirma SGS as well. We were just chatting with the management too. The margins have slipped and they don't see margins coming up meaningfully anytime soon. 4.5% lower for Sirma as we speak right now. So that's pretty much it. I also want to revisit what the likes of Idea, Sun Pharma, Birlasoft, etc. are up to. Remember, these were big movers in trade yesterday. Vodafone continues its uptake. Sun Pharma as well, seeing just marginal green ticks. And Birlasoft holding up 1.25% as we speak right now. Nooresh, any observations you're making, the start of trade? Any stocks that you're looking to trade to?
A decent recovery on the index as well as the small cap index has made a good 1.3% move. So the stock I would be watching out for and adding on to is RBL Bank, which has corrected the most, could go towards 235, 245 in the short term.